it's been a year in the roller coaster for gold prices, with the metal showing a flat performance year to date as of the 21st of December, but moving within a very wide 22% range between March highs and the Q4 lows. So what would be the outlook for gold in 2023? Is the metal expected to actually reach fresh all-time highs as a recession forces the Federal Reserve to turn its policy, or there will actually be renewed downside pressure for gold prices because inflation proves to be stickier than expected and the Fed remains hawkish for longer? Before presenting our gold outlook for 2023, let me remind you to subscribe to our Capital.com YouTube channel, like the video, and leave a comment below if you enjoyed watching. Welcome to this new Capital.com video. I am Piero Cingari, market specialist here at Capital.com, and today I'm going to express my views on the gold outlook for 2023. But first, let's see what actually happened to gold in 2022. As I said, the performance of gold year to date is broadly flat. It's better than the stock market, which is 20% lower, and the bond market, but gold has underperformed the US dollar. And when compared to the performance of other major metals, we saw gold mixed, because silver actually rose 5% year to date, while copper slipped nearly 14% since the start of the year. Now, the year actually started on a strong foot for gold prices. We saw a 16% jump between the end of January until the 8th of March, when gold prices hit $2,050. It was a period of very strong geopolitical tensions and market risk-off sentiment because of the war in Ukraine. But starting from mid-March, gold prices turned lower, and that of course was due to the fact that the Federal Reserve started its hiking cycle. It was one of the fastest hiking cycle in the Fed's history. The Fed hiked interest rates by 425 basis points from March to December. Now gold slipped 22% from the March highs to September lows at $1,615. And at the same time, we saw a very strong rally in the US dollar and higher US Treasury yields, which of course negatively affect gold prices. But after hitting actually for 3 times in a row a so-called triple bottom in September, October, and November, gold prices rose 12% ahead of Christmas. Now it's been a quite strong rebound for gold prices, which has been aided by the fact that October and November, the US inflation actually turned lower than expected, which essentially pushed the market to started to price in a relatively more dovish Federal Reserve next year. even though in December, during the last FOMC meeting, the Federal Reserve actually pushed back against market expectations on interest rate cuts in 2023, because the Federal Reserve signaled a medium preference for interest rates to rise to 5.1% in 2023. The market hasn't really priced in that change in the Fed stance. So the market continues to expect a relatively dovish Federal Reserve in 2023. And that was the reason why gold prices actually held quite nicely following the December FOMC meeting. Now, for the gold outlook in 2023, it's important to understand the macro context and the economic backdrop. And let me briefly summarize the main economic projections made by the Federal Reserve as of December 2022. So, as I said, the Fed expects the federal fund rate to reach 5.1% in 2023. That was a bit higher than the 4.6% expected in September. Now, why interest rates are very important for the gold outlook? It's because gold is essentially a non-yielding asset. So when interest rate rises, it's a negative effect for the price of gold, because it reduces the incentive to own and buy a non-yielding assets like gold. Now, the Federal Reserve has lowered its real GDP projections for 2023 to 0.5% from 1.2% in September, which essentially means that the Federal Reserve expects some economic weakness next year. So here, of course, the key question would be whether 2023 will see actually a US recession or not. Regarding the inflation outlook, the Federal Reserve has revised the inflation estimates higher. Now, the PCE inflation, so the overall inflation, is expected to average 3.1% in 2023 from a 2.8% projection made in September. Core inflation, which excludes energy and food prices from the basket, is expected to average 3.5% next year. So there is a condition of actually stagflation in the US economy, because we are seeing the growth outlook worsening while inflation estimates remain quite sticky. Another key theme for gold next year is to assess its relationship with US real interest rates and the US dollar, of course. Now, as this chart here shows, we are actually seeing gold prices trading at a premium when compared to the level of US 10-year real yields. Now, the 10-year real yields basically reflect the monetary stance of the Federal Reserve. The higher the real yield, the more hawkish is the Federal Reserve, and thus the stronger the downside pressure on gold. Now, real yields basically measure the return net of expected inflation that an investor obtains when he buys a 10-year Treasury bond. Now, after the Fed aggressively hiked the interest rates in 2022, we saw real yields rising from negative to positive territory. And whenever real yields have traded in a positive territory, gold has consistently traded below $1,500. So there was a strong negative link between U.S. real yields and gold prices. Now real yields are currently trading at around 1.5%. While gold is trading around $1,800, which means that the historical link between these two assets seems to have weakened in 2022. However, we should, of course, consider real rate as a key factor that could affect gold prices next year. There is instead a very strong and, of course, negative correlation between gold prices and the US dollar, and I think that this relationship will remain strong in 2023 if the dollar weakens as a result of a more dovish Federal Reserve. Gold would certainly benefit from this development. On the other hand, if the Federal Reserve actually maintains a firmly hawkish stance for an extended period of time, the greenback can be supported by tighter monetary conditions, and of course, non-yielding assets like gold would suffer. Now let's discuss about the bullish scenario for gold next year. Now the bullish case for gold prices in 2023 involves the arrival of a global recession and a shift from major central bankers towards looser financial conditions, especially in the US. Now, if the US economy actually enters a recession and inflation continues to weaken further from here, we can actually see rising unemployment rate, making it harder for the Federal Reserve to maintain a hawkish stance. So any dovish signals from the Federal Reserves are likely to produce a bullish effect on gold prices. Another positive catalyst for gold next year is a successful reopening in China. Because that could drive the demand for physical gold higher, given that China is among the world's top consumer of jewelry gold. Now, if these catalysts materialize, so if we see a global downturn, a global economic downturn, but the Federal Reserve shifting its policy, gold might rise, let's say, by about 10% to around $2,000. Now, there is also an exceptional, I would say, bull case for gold in 2023, which is characterized by the arrival of a stagflation, which means that we end up in a global recession, but we actually see a sticky high inflation, and the Federal Reserve is also more worried about the growth outlook. So the Federal Reserve starts to avoid a further tightening in financial conditions. Now, if this is the case, gold prices can actually see a very strong investor demand, because investors would flee stocks due to the recession, and bonds because inflation remains very high. Now, gold would be perceived as the only asset in town to protect against stagflation, and we could see gold prices testing and possibly breaking above its all-time highs of $2,075. Let's now consider also the negative side, so the bearish case for gold in 2023. And that has to do with the fact that the Federal Reserve continues to tighten monetary policy. We saw the negative impact that rising interest rates produce on gold prices. So if the Federal Reserve pushes back against market expectations. So if the Fed actually delivers its promised interest rate hikes, that would be a further downside pressure for gold. Now, overall, I think that the worst period for gold was during the summer of 2022, when the Federal Reserve was hiking interest rates at a 75 basis point pace. Next year, if we see a weakening in the economic growth, I think that even stronger than expected interest rate hikes could actually minimize the impact on gold prices, and gold may suffer less than it did during the second quarter and the third quarter of 2022. When considering the key resistance and support levels for gold in 2023, on the upside, the first resistance is located at 1841, which coincides with the 50% Fibonacci retracement level from 2022 lows to highs. Now, this is a crucial level to keep an eye on, because if gold actually rises above this area, it might mean that the major bearish trend is gone. Above this level, we have the psychological threshold of 1900. And then we will get actually very close to the March 2022 highs of $2,050. Now, on the downside, we have the psychological support located at 1800, which is also the level at which the 200-day moving average trades. And then below that point, we have 1720, which is an area basically that was resistance in October and then became support in November. And finally, we have the 2022 lows at $16-15. Now let's jump on the gold chart analysis. Here we have the daily chart for gold. Now, as we can see, there was here a triple bottom in September 28th, and then October 21st and November 4th. And then we saw a nice 12% rally until the 21st of December. Now, gold has been able to break above these declining 2022 channel, starting from the March highs and ending in November. Now the price action has been also able to break above the 50-day moving average, the green line here, and the 200-day moving average, which is the yellow line here. We are seeing signs of bearish RSI divergence because here the momentum oscillator entered the overbought territory in mid-November, and then started to trend lower while prices actually continued to rise to $18-16. Now, as I said, when considering the key Fibonacci retracement levels, it's important to look at these level here, 1842 or 1800. This is a key Fibonacci retracement level because it means that gold would have retraced almost half of the 2022 range if prices are going to hit there. So I think this is a key area to keep an eye on. If gold is able to clear these resistance, we may actually see bullish attempts towards 1895, which is very close to the psychological 1900 mark, and which is the 61.8 Fibonacci retracement level. And then we can actually see a further jump to 1972, which is the 78.6% Fibonacci retracement level. Now, on the downside, if gold prices instead hit bearish resistance at 1841 at the 50% Fibonacci retracement, and then actually start to pull back, it would be seen as a letdown for bulls, and this could lead to more pressure to the downsides. Now, sellers could actually be reinforced by a bearish RSI divergence, because we are seeing prices hedging higher while the RSI indicator is trending lower. Now, if this technical pullback scenario plays out, the first level of support would be around 1790, which is the 38.2% Fibonacci retracement level, and below that we have this area here where the two moving average are converging with one another, and then of course below that we have the 23.6% Fibonacci level at 1722. Hope you guys enjoyed watching this video. Please subscribe to our YouTube channel if you liked it, and don't forget to leave a comment below if you have any questions. We will get back to you shortly. Now, let me also remind you that you can read our gold price analysis on the Capital.com website, as well as other analysis involving major asset classes. Thank you so much for watching this video, and I'll see you next time.